Good afternoon, class. My name is Naislet Rodriguez, and I'll be doing a brief introduction of our presentation. I'm a member of Group 3, and we are excited to let you know a little bit more about the company we chose as a team to conduct our strategic audit project, which will be Morgan's Hotel Group. Enjoy! The fact is that there's no one in this world that either looks or behaves the same, but nonetheless, we identify each other as part of something bigger than ourselves individually. Such may be the language we speak, our nationality, and or the city in which we reside. Therefore, our team looked for a company that, even though pertains to an overall industry, it also had elements that represented our human race, our distinctiveness, uniqueness, as well as our different visions and perspectives in life. Luckily, we found the Morgan's Hotel Group. The firm was not joking when decided in 1984 that all of their hotels would have different, exclusive, and unique design styles. Today, such attribute has given them a very concise competitive advantage within the hospitality market. Let's see why. Now, each of my teammates will expand on the following sections.
Morgan's Hotel Group was created from a simple vision of introducing a new concept to the existing hospitality industry. The visionary was Mr. Ian Schrager, an American hotelier and real estate developer. His idea was simple, but an instant success in the hospitality industry: the introduction of boutique-style hotels. This strategy provided Morgan's Hotel Group with a competitive advantage over competitors, and today, this organization remains in a strong position within the hospitality market. The company strategy: to provide a distinctive brand, boutique styles, to obtain irreplaceable assets in prime locations within historical strong markets, to build on a scalable infrastructure, to continue the addition of new hotels owned and managed, including the expansions through the Caribbean and the world, to focus on management and branding opportunities, to secure management contracts for up to 25 years for both Royalton and Morgan's, two previously owned hotels who are now being managed by the company. Morgan's Hotel Group continues to expand with future properties at different stages to include Delano in Cabo San Lucas, Mexico, and a Delano in Turkey. Morgan's boutique-style hotels continue to expand around the globe.
Although Morgan's Hotel Group has attained a great reputation among its clientele, it has recently experienced difficulty in maintaining the financial stability and profitability. As noted in the liquidity ratios table, its ratios have decreased over the last 3 years. With a current ratio of 0.21, the company doesn't have the ability to meet its short-term liabilities with its short-term assets. The company's asset ratios also show a decline from 2008 to 2010. Nevertheless, even though its total asset ratio had declined from 0.37 in 2008 to 0.27 in 2009, it increased slightly to 0.33 in 2010. Overall, the company's assets are not effectively generating revenues. The company's profitability ratios show a decline over the past 3 years. Its current profit margin is negative 0.34. The company's performance for the last 3 years has been poor. Its debt ratio has increased from 2008 to 2010. A company with such a high debt ratio has a lot of debts financed by its debt holders compared with its owners. The company's leverage is high, meaning that this company has a lot of debt and as such its stock is at risk. If the company were to go bankrupt, there may be nothing left over for its stock owners after the company satisfies its debt holders. The company's market ratios have also declined. Its earnings per share decreased from negative 0.15 in 2008 to negative 0.22 to 2010. The price per earnings indicates how much investors are willing to pay per dollar of current earnings, and in this case this ratio doesn't have any meaning because the company's earnings are negative. Overall, this company's financial performance has been inefficient for the last 3 years.
Hello, my name is Daivelis Garcia, and I'm going to discuss the internal analysis of Morgan's Hotel Group. As we know, Morgan's Hotel Group changed the way guests looked at hotels when they established the boutique hotel concept. which today stands as one of their most significant and valuable resources. Morgan's Hotel Group's current brand loyalty, awareness, and recognition have been created through its impressive, original, and unique designs, which have made customers prefer Morgan's over other hotel chains. This has been accomplished by their combination of classical and modern decor, along with their innovative food and beverage concepts, which contribute to their exclusive hotel atmosphere that engages customers to promote the group. Another fundamental resource that has attributed to the success of the company is the different choices of bar and restaurants they offer their guests. What makes their bar and restaurants so rare and unique are the different culinary styles that come together to provide customers with an unimaginable dining experience. If their concepts and culinary fusions were not sufficient, Morgan's Hotel Group has also expanded their market to include hotel-style residences. Another valuable capability that Morgan's Group enjoys is the geographic locations of their hotels, which are always strategically located in metropolitan areas like New York City. Moreover, Morgan's has accomplished their success thanks to the difficulty the competition faces in imitating resources and capabilities such as their organizational structure and personnel. Their diverse management team counts with many different talents such as design development, not to mention the fact that the firm only hires the most widely recognized decorators and interior designers to contribute to their distinctive, unique, and exclusive hotel designs, which are almost impossible to imitate. Morgan's Hotels Group's resources and capabilities have provided them, without a doubt, the ability to successfully integrate their assets into their portfolio as they grow and expand within the industry.
It's clear that there is a large quantity of hotels in the world. In fact, the number is so high that it's nearly impossible to determine an exact number. As competition in the lodging industry is not perfect, there is a lot of rivalry in existence. Although there are myriad options, given the locations of Morgan's hotels, we can assume its closest competitors are those hotel chains that everyone is familiar with: Wyndham Worldwide, Marriott International, Starwood Hotels and Resorts Worldwide, and Hyatt Hotels Corporation. Cost is one of the primary factors that gives a hotel a competitive advantage over another, since they are in essence fighting for the same customers. The advent of websites such as Hotels.com and TripAdvisor, incorporated customer reviews, and a large amount of positive or negative feedback will greatly affect the final decision a client makes when choosing accommodations. Because of this, service has become almost as important as room cost in the lodging world. This rivalry has caused the threat of substitutes to be greater than ever. Many of a hotel's greatest strengths, such as services, amenities, etc., are easily replicated. If one hotel doesn't meet a guest's expectations, there are always several options nearby to choose from. Buyer power is strong in lodging, particularly in the cities Morgan's operates: New York, London, Miami, San Francisco, Los Angeles, and Boston. These large and tourism-focused cities have many lodging options, and the consumer is able to compare each aspect of a property via the internet. In essence, the buyer sets the price. If bookings for a time period are low, the hotel will make a price adjustment based on its competitors' prices. Because of the immense strength of buyer power, supplier power is not an important factor in this environment. Barriers to entry in the lodging industry are very high for a variety of reasons. Primarily, building and marketing a new hotel is very expensive, and it is difficult to compete with the chains that are already well known. Also, location is arguably one of the most important keys to a hotel's success. In saturated markets such as Manhattan, there's little or no room to build new properties.
MHG has hotel properties in prime locations around the world, however, lags behind in market penetration. Thus, a more aggressive overseas expansion may be necessary to realize substantial growth. Qatar remains the region's leader in GDP per capita, but if MHG is to invest in this market, there will be challenges to overcome and rivals to combat. Also, external factors such as the decrease in oil and gas production in the Middle East, as well as unrest in the region, could affect demand for luxury accommodations. The hotel market in Turkey has been booming and is on track to show continuous growth. A risk, though, is that the market in Turkey is dominated by upscale hotels. Therefore, MHG may have stiff competition from other luxury brands and will have to prove it is indeed different from the rest. China could be a great investment opportunity for MHG. However, they will have to compete against other strong luxury brands. This type of competition may be too much for MHG to bear alone and may have to partner with other key local players in the market who are more familiar with the dynamics and opportunities in China. MHG needs to reduce its overall debt, which has weighed heavily on the company's ability to invest in other areas. The Delano in South Beach could be a potential for sale and will give the company a needed boost in capital. However, it could erode its market share as well as cause a loss of reputation with the Delano brand. MHG's hotels are known for their one-of-a-kind, out-of-this-world decor and exuberant food and beverage venues. This is an area where they could continue to invest and push the boundaries. The risk here is overinvesting and not being able to reap a return on investment, which could force the company to cut back in other needed areas.
Lower debt, increase value. To increase their profitability and remain financially strong, the Morgan's Hotel Group must reduce their debt by selling some of its hotels and refinancing their debts. If senior management does not follow this route, it will put the company in a very unpredictable position, eventually losing market share and the opportunity to generate capital growth. While reducing long-term and short-term debt increases future net cash flow, it also gives the Morgan's Hotel Group a stronger balance sheet by minimizing its cost of capital and the opportunity to invest in more profitable cities. In contrast, our unhealthy economic situation brings several challenges to the hospitality industry. The luxury hotel market depends on corporate travelers and wealthy consumers. With most companies cutting travel allowances and with the increase of oil prices, it is difficult to predict how long it will take the Morgan's Hotel Group to be profitable. Expand brand awareness. To maintain its competitive advantage in the boutique-style hotel industry, they should maintain and invest in their brand strength and luxurious ambience and exotic menus. They should also enhance customer relations and experience. The key is to innovate and keep its leadership position in the luxurious boutique-style hospitality. This will not only influence in employees' commitment and propensity to collaborate, but it will also make their customers feel extremely valuable and part of their culture.
Morgan's Hotel Group is a fully integrated hospitality company that operates, owns, acquires, and redevelops hotel properties in gateway cities and select resort markets worldwide. Since 1984, Morgan's has been widely credited as the creator of the boutique hotel concept. The company has gained experience operating in a variety of market conditions while managing a portfolio of 12 luxury hotel properties. With a growing portfolio, Morgan's has significant competitive advantages, which include segment creation and leadership, distinctive lodging experience, brand strength and awareness, financial outperformance, experience management, and extensive infrastructure. The company leverages its portfolio of brands in gateway cities and resort markets through third-party management contracts and joint venture partnerships. With a renewed focus, Morgan's has shifted towards an assets-light business model that places an emphasis on higher margin management and branding opportunities. As of December 2010, Morgan's market capitalization was estimated at $272 million. Over this same period, the company's annual sales increased by more than 5%. The company operates with approximately 4,600 employees. The recently appointed Chief Executive Officer is Michael Gross. Morgan's has a cash flow problem. With a free cash flow of negative $20 million as of December 2010, the company's previous business model to include acquisitions and expansion is no longer the best strategy for the health or wealth of the company. Moreover, masked by its strong assets portfolio, Morgan's is simply operating to pay its debt. That is, the company is over-leveraged. In short, with a stable collection of boutique hotel models, the company has thus far flipped hotels to stay afloat. It is recommended that Morgan stay true to form its refocused business model to pursue higher margin management opportunities while retiring current outstanding debt and future long-term debt obligations.